Welcome to the December 2022 monthly motor checkup. My name is Dave Lundgren and I am the Chief Market Strategist here at MOTR Capital Management and Research. As I've been detailing in the notes throughout the course of the month, we have seen some positive inflections, enough to really distinguish the current rally from what we saw over the course of the summer. But unfortunately, there are still too many negatives for us to really latch onto a bullish outlook here. So especially with the market overbought and into resistance, we really want to be cautious here and consider layering back on some short exposure. So the tactical setup is that we are into resistance, and whatever marginal improvements we have seen over the course of the past month are likely to be tested as the market kind of does a back and fill in the course of this resistance area that we'll detail here in this monthly video. There are still plenty of cyclical ideas to consider for long exposure, but overall we want to remain gross down, so don't take on full positions despite taking on cyclical exposure. Just keep it gross down, and if you can, raise cash. And as I said, deploy shorts, particularly now that we are back to overbought across the range and into resistance. And then I'm going to hop on a little bit of a soapbox and discuss this notion of smartest investors in the room. Hope you enjoy the video. Before we get started, I just wanted to run through this checklist of trend change concept that I refer to often, because we'll talk a lot about it in this month's video, and it also underpins the risk gauge and many other things that we do. But it's essentially a concept that I've developed to help demonstrate the manner in which trend changes and how a trend follower might respond to it as it unfolds. So as you can see here, there's 4 steps in the checklist. The first step is to break the trend. So if you're long this stock here and you're concerned about it going down to 10 eventually, you know that it can't happen until it breaks its uptrend. So until it breaks its uptrend, you should worry a lot less about it getting down to 10. But once it does, you've now checked the first box in the checklist of trend change, and the point being that the stock can't go to 10 until it breaks that uptrend. So this is why it's very simple but also very powerful. The second step in the checklist is to violate the last important high or low in the prior trend. So here's your uptrend, here's your prior low, drawing a straight line across. Here's point number 2, breaking the prior low. So you've now checked both boxes that really actually define trend reversal, because they happen in the moment that trend reverses. So once you've been able to check this second box, you really have already got the definition of trend change confirmed. The other 2 steps are the 50-day crossing below the 200-day moving average, and then the 200-day moving average eventually turning down. Those 2 also have to happen. They literally have to happen in order for this stock to get down to 2, but they generally are lagging indications of trend change, meaning that they happen after the trend is already reversed. But nonetheless, if you've got the first 2 boxes checked, you don't actually have confirmation of trend reversal until these other 2 things happen as well. So you do need all 4 of them in order for something really bad to happen on a chart. But the point is to follow the sequence as it unfolds, as you're monitoring trend. And what I've done in our research process is I've systematized this 4-step process. And this is where we see the risk gauge, for instance, summarizing what's happening in the market from the bottom up, 1 stock at a time. It is, in essence, taking this concept at the individual price trend as well as relative performance trend, and then we also add in cross-sectional momentum or 12-month, 3-month, 6-month momentum, etc., as well as market breadth and individual stock volatility. All 5 of those things come together to form the risk gauge, but the most important input is trend, because after all, this is what we trade, this is what we invest in, and so this checklist of trend change is a very important part of that risk gauge. So I wanted to cover that just before we get into the presentation, so that we have this fresh in our minds. So taking that checklist of trend change concept and applying it to these charts that we see here of the S&P 500, the NASDAQ 100, and the S&P 600, we can see clearly that from a checklist of trend change perspective, there is no there is no indication of trend change yet, and that's important. That should drive your overall positioning in the market, which we'll get to in a moment. But you can see the downtrend is still in place. The 200-day moving average and the 50-day moving average are still configured negatively, and this is your last swing high in the downtrend, so you're still below there. Same thing here and same thing here. So from that perspective, all three of these indices remain in a downtrend. And what we're seeing, and I've mentioned it in the recent weekly notes, is that this rally, at least as it relates to the broad market, this rally, the conditions underpinning this rally are far better than what we saw here. But they're still not, I wouldn't characterize them as being good necessarily. They're just at the margin better than what we see here. So it's a better start to what we had in the July to August rally. But nonetheless, there's still a lot to be desired. You can even see here the Nasdaq is nowhere near its 200-day moving average, the Nasdaq 100, and so, you know, although there are some things that we can point to, and we will as the video unfolds, I still want to keep a overall defensive positioning, meaning retaining some cash and definitely having some short exposure on as well, with the idea that when the market gets oversold, reduce your short exposure, and when it gets back to being overbought, which it is now, redeploy your short exposure, with the idea that all the while you're also at all times constantly pushing your long exposure, grossed down as it may be right now because of the bear market. You're still constantly pushing it towards what's leading with a positive trend structure and outperforming the market. And we'll have some ideas on that in a moment. So over here we have the current risk gauge, and you can see that we have seen some continued improvement. So we're showing you the last 3 months of the risk gauge, and this is what I pointed to earlier, and I've referred to it in the recent weekly notes. When you're looking at the risk gauge across 4 time frames, so we have spray, ripple, wave, and tide, all of which is explained down here. It's a reference to the way Charles Dow referred to and explained how the various time frames of trend can coexist and oftentimes move opposite of one another, which we're seeing an awful lot of today, these days. But nonetheless, think about this as your daily, weekly, monthly, and quarterly time frame. This time frame here is the one that really provides the context for all the back and forth movement that we see in these shorter term time frames. And so with this quarterly time frame, the tide signal, hovering down at 7 just above risk off, if you're in this mixed area on the tide signal or in that quarterly chart, even though it's, you know, quote unquote only mixed, the fact that it's the quarterly chart indicates that you can actually be down 20%. So in here on this quarterly time frame is actually a cyclical bear market, and obviously we're experiencing that. And so for this, if were this indicator to get down into risk off, that would open the floodgates to a more of a crisis bear market, which was the topic of last month's video, in highlighting the fact that so far we've avoided that crisis bear market. And since that video, we've seen these 3 time frames of the risk gauge start to improve, and this is critical. You can see here that they're not, as I said earlier, they're not, I wouldn't characterize these as being good, but they're certainly better than they have been recently. They're certainly better than they were from the July to August rally, at which point they both, this is November, but very similar in August, these 2 time frames stayed in 8, despite the fact that we had an 18% rally. So here we have another rally going on. We're back to the 200-day average, and at least this time, these 2 time frames, the weekly and monthly, have come up out of risk off. So this time frame, this quarterly time frame, cannot get better. This is a fractal concept, meaning that these are all linked together. So this time frame here cannot get better unless these time frames get better first. So the fact that they are getting better at the margin is certainly way better from a structural standpoint than what we saw from July to August. So I'm encouraged by that, but nonetheless, as we'll see as the video unfolds, there are still a lot of things that remain of concern to me, and therefore make me want to continue to recommend that we don't get fully invested and certainly don't cover all of our short exposure just yet. So when you look at the risk gauge at the sector level, not a lot has changed from last month. But this is something I want to keep in front of you each month because it's a super important concept. Here we have the risk gauge for the overall market, which we just covered, and then the 5 leadership sectors appearing in order of their rank. So you see energies number 1, staples number 2, utilities number 3, industrials 4, and materials number 5. So a few things to point out here. One is energy from a longer term perspective. Remember that quarterly time frame looks very strong, but we do see it weakening in here quite a bit, despite the fact that the market's rallied quite a bit off the October bottom. So we'll cover this in a moment, but this is certainly the weakness that we're seeing, as I'll show you, is starting to show up in the risk gauge. And then a couple of other things that I want to point out. One is, again, staples and utilities in the leadership spot is generally not a positive configuration for the broader market. Generally, you don't see staples and utilities leading if you're in a healthy, robust bull market. So the fact that we're still seeing these two sectors cling to leadership positioning is at minimum, it's a reason to not be overly aggressive in your broad portfolio positioning. And then secondly, we do have some cyclical sectors vying for leadership, but it is interesting to note that industrials are ranked number 4, despite the fact that they are still quite negative in the longer term time frame. So the point being that if this is all it takes to be ranked number 4, you know you're not in a robust bull market. And of course, materials is also hovering just above risk off in crisis mode in that quarterly time frame. So this is not what you typically see in a robust bull market. So just want to be mindful of where these sectors are positioned from a risk gauge perspective, and then just let that be reflected in our positioning. And then when we look at the risk gauges for the sectors that are lagging the market, of course, it's just not a pretty picture, to say the least. We have a lot of cyclical exposure down here, discretionary financials, technology, and a lot of these the growthy media names. You can see how poorly configured they are. There's a lot of crisis going on here when you're down here in the risk-off category in this tide or quarterly time frame. Keep in mind, this is like the quarterly charts. So these are the charts that are driven by fundamentals, and those fundamental trends, as reflected by these quarterly charts and picked up by vis-a-vis this risk gauge, is demonstrating a lot of crisis being priced in. So once again, you don't necessarily need discretionary to be leading, or tech to be leading, or the media space to necessarily be leading in a bull market, but you certainly can't have them looking like this. So as long as the leadership is barely hovering above crisis itself, and then you have the laggards looking like this, once again, there's just not a lot of reason at this point to be super optimistic and aggressively positioned in your portfolio. So if we just look at the 12-month momentum rank across the sectors, and we can just see how the ranks have progressed over the past year, we see a lot of the same, quite frankly. Technology and media have been at the bottom and remain at the bottom. Consumer discretionary also clinging to the bottom, and this just shows through time that there is no effort to find a bottom for these important cyclical sectors. We do see, once again, materials and industrials clinging to somewhat leadership positioning, but they're just unable to really wrestle away from staples and utilities, those number 2 and number 3 spots. So once again, when we're looking at the current mixture of leadership, although energy continues to hold onto its long-term one-year performance rank, despite that, we still have staples and utilities just below there, and until we can identify some change in this configuration, once again, we want to just be cautious with our portfolio positioning. So I just showed you the 12-month momentum score for the energy sector and how it was holding at 1 for the past year, and that shows up here in this relative performance chart of the XLE versus the SPY. So this is the energy ETF versus the S&P ETF, and you can see a very strong relative performance trend. This is a 2-year trend, so it's not surprising in that light to see the momentum score hold at 1, or the best rank for the past year. But what I pointed this out in one of our recent weekly notes, and I just wanted to go over it in the video just to kind of walk through it a little bit. But one of the things that does have me concerned with respect to the energy outperformance is we did see a new high from energy recently into early October, and that relative high happened despite the fact that we had this divergence. So down here we have the red line is crude oil versus the S&P, and the green line is crude oil itself. So between those two things, those are the sort of the relative drivers behind this relative performance trend, and so we can see energy relative to the market hitting new highs, but there's a clear divergence here. And if we were to drill down on this on the red chart, there is a very clear top here, and on the green line as well. This is the mirror opposite of what we had at the lows, into the COVID lows, where crude oil versus the S&P both bottomed ahead of the relative performance of energy, which led that relative performance line to eventually turn higher. My concern is that we have something similar happening, only in the opposite. So because this is happening in the near term, and it's reflected, as you can see here, over the past few months, this type of a divergence is not going to show up yet in the 12-month momentum score, because as you can see, over the past 12 months, it's still very strong. But all 12-month trends change with 1 month, 3 month, 4 and 5 month deterioration, and my concern is that we're starting to see that here. So overall, I want to continue to retain some ownership in the energy space. It's still leadership, but this is enough for me to want to respond and reduce that overweight for the first time in a while. So when we drill down on the sector performance since the October bottom, we're starting to see some pretty interesting things. So first and foremost, I want to point out that the average tech stock is up 6.9% relative to 7.1% for the average stock in the motor universe, which is about 2,200 stocks. So here again, we have a nice rally in the market, giving the tech sector an opportunity to demonstrate that it's ready to lead, and we certainly don't see that. And of course, media is up 3.6% on average. So despite these two sectors being down and out and really washed out, and several folks calling for some sort of a bottom there, I mean, there's the opportunity to demonstrate leadership has been presented since the October bottom, and we're certainly not seeing that. What's worse, of course, is that again the average stock is up 7.1% since the October bottom, and look at the performance of staples and utilities. They're actually outperforming. That's just not bull market activity. And then I hinted earlier that I wanted to point out something that was going on in the energy space. And if you look at energy, actually since the October bottom, the actual performance has been has been lagging the broader market by quite a bit. The average energy stock is only up 1.7% since the October bottom. So we have a lot of things happening here beneath the surface. Seeing what I'm seeing in energy and the drivers behind the relative performance for energy, I think there's reason enough to take that exposure down. The fact that industrials and materials are still holding in well, I think is reason enough to keep that exposure alive and well, and maybe rotate some of your energy exposure to here. But I would just continue to resist that the call to increase your exposure, certainly in a big way in technology and media. In technology in particular, there are some one-off names that I've mentioned in the weekly notes, and that I would recommend exposure in. But broadly speaking, it's still got a long ways before it's going to be leadership. To provide some perspective on just how bad things might get for technology, I wanted to just update a chart that I've shown in the past. So the blue line is the ARC ETF, and you can see from 2014 to 2022, and we're just overlaying that with the NASDAQ from 1993 to 2003, and then the Dow Jones Industrial Average from 1924 to 1934. So obviously these are the at least three prominent bubbles that we can identify in history. And so obviously the ARC ETF is down an awful lot, so much so that some might say that it's finally reached the bottom. But even if it has reached the bottom, the key thing to remember is that there's still a lot of work to be done. And although it's down a lot, we can see that from here, were the ARC ETF to go as far down as the NASDAQ went after its bubble, it would still drop another 24%. as you can see here. And if it were to go down as far as the Dow went from where it is right now, it would drop another 52%. So, there are some similarities here. This is the COVID decline, and you can see how the lows for the NASDAQ went back to these lows, and this is where the arc is, and so there's a lot of similarities there, but I just don't want to lose perspective on a couple things. One is the trend is still down. Remember that checklist of trend change. There is no indication of any improvement here, and as bad as it's been, and as we want to think that we're at the bottom of the ocean here with this sinking arc, things can get a lot worse. And until we can start to identify some indications of bottoming taking place in this sector, I just would be more of the mind of that things can get worse before they get better. Of course, the real conundrum with the whole call on the tech bottom is that even though the sector itself might bottom, that doesn't necessarily mean that it's going to translate into relative performance. So here's the last bubble in the Qs. This is the Qs, the NASDAQ 100 ETF versus staples, and the NASDAQ 100 ETF versus energy. So this is the last bubble that we had in 1999 to 2000, and of course the relative performance was very strong relative to these two sectors. But when it peaked, we know that the dot-com bottom was here, and this is when, of course, technology bottomed with the rest of the market. But that only ushered in a very prolonged period of relative quagmire, if you will, for the tech sector. So while the rest of the market was up and away and off into the next bull market, the tech sector actually went on to underperform for a number of years. So, it's one thing to identify a turn in the absolute price trend, but the whole point of the risk gauge that we talked about earlier is that it does take into consideration more than just price trend, although price trend is the most important because that's the thing that we buy and sell. In that risk gauge is included relative price trend, momentum, breadth of the sector, as well as the volatility of the individual stocks. So all of that will come together, and it won't start to really demonstrate leadership potential until those things come together for the tech sector. And it's conceivable that the rest of the market will eventually bottom here, maybe sometime early next year, and leave the post-bubble condition for the tech sector for a number of years. So we see this happen from 2000, from the peak to 2009. And again, that was a very robust bull market, and that sector did not see leadership again until the GFC bottom. So from one bear market bottom to the next, it actually underperformed by quite a bit. I've showed a couple of data points that demonstrate that staples are outperforming the broader market. So here's the problem with that, and it should be relatively clear. But this red line here is is staples versus the market, and of course the black line is the market itself. And so you'll note that the only time that this red line is rising is during bear markets. And so when you see the staple sector in a leadership spot, this is why I tend to not be terribly optimistic on the broader potential for the market, simply because this is a safety sector. It hasn't always been, of course, in the 1980s. It's not shown here, but in the 1980s, when a lot of the staple companies had significant growth opportunities in emerging markets, they were actually bull market leadership. But they haven't been bull market leadership since the late 90s and in through now, and that shows here very, very clearly. So whenever you have a downdraft in the market or a bear market, that's when you get your relative performance from staples. Here's the problem. Here's your current relative performance trend. We know that it's been strong. We have many data points to demonstrate that, not the least of which is the risk gauge and the relative ranking, etc. We can see why it's been strong. We're in a bear market. But when you drill down on this recent relative trend, you get this inset here, and you can see that the relative performance is once again breaking out to new highs. As I said earlier, that's despite the fact that the market's had a nice rally off the October bottom. Despite that fact, the relative performance for staples is breaking out yet again. So again, we're constantly on the lookout for reasons to turn more optimistic. We see some, but by and large, there's a lot more headwind than tailwind. So we want to retain somewhat of a cautious view for now. One classic signal that's potentially giving us a positive read on the market is Dow theory. So Charles Dow, back in the late 1800s, he developed the transport averages and the industrial averages, and he did so to look for confirmation in divergence between the two indices, thereby gleaning some sort of a message about the health of the economy vis-a-vis the wisdom of the crowd and the message of the market. And so the idea being that the transports and the industrials should be trending in the same direction. Of course, that being up if the economy is healthy and down if the economy is not healthy. And so as long as they're trending in the same direction, they're signaling the same outlook for the economy, for better or worse. And when you really start to get your signal is when they start trending in opposite directions. And so we know that into the October bottom, the transports went to a new low by quite a bit. But although the capital goods index, which is what I'm using for the industrials, although that index did go to a marginal low, it was just barely to a new low. So in many ways, that would be one divergence to indicate that there's a possibility that the market from a bottom-up perspective is starting to pick up on improving economic conditions, and that's starting to reveal itself vis-a-vis these trend changes. And then subsequent to that bullish divergence at the bottom, we then have had capital goods break above the August peak. So if you remember that checklist of trend change, you can see that all playing out here. So you have the break of the downtrend, break of the swing high, crossing of the averages, and then the longer term average turning up. So from that perspective, we've checked all the boxes in the checklist of trend change for industrials. So that is a positive. But unfortunately, as it stands right now, it's still divergent because the transports are not only not above their August peak, but they're still below a still declining 200-day average. So this is something to monitor. If I was to try to point to something else that I would say is at the margin of positive, the fact that capital goods or industrials are behaving the way they are, this would certainly be one. But this is not a full-blown bullish signal from the Dow theory until the checklist of trend change can be identified here on transports, and as I just demonstrated, we're pretty far from that. And to provide another perspective on where we stand across the market from a breadth perspective, this is the advanced decline line for the various indices. So this is just indicating what's happening on average within each of the indices. And you can see here that it's at best, it's neutral. So this is the S&P 500 large cap. At best, once again, think about this through the lens of that checklist of trend change. This is sideways at best. The 200-day moving average is running sideways. So this is the breadth on the S&P 500. And then as you move down the list, it just progressively gets worse and worse, with some of these indices not even recovering above their 200-day moving averages. So there's from a bottom-up perspective, there's just not a lot to be celebrated at this point. So we're triangulating this. We're looking at this from a lot of different angles and measures, both vis-a-vis the proprietary models that we have, as well as the more traditional indicators like these breadth indications. And despite turning over a lot of rocks, and we find a few things that we like, but by and large, most of what we're seeing is still neutral at best, if not showing risk of further weakness once this rally is completed. When we look at the measures that I guess you'd call them relative relationships, the things that drive the market from bull market to bear market, here we have the S&P 500 at the top on both sides here. Over here we have relationships within the equity market. So we have discretionary versus staples, clear downtrend, banks versus utilities, lower highs at least. We can say that took out this low from a checklist of trend change perspective. There's your trend, broke the last swing low, and now everything's starting to roll over. So downtrend here as well. And then high beta versus low volatility. These are all things that generally go up during bull markets and go down during bear markets, and right now they're going down. So again, no indication that there's anything remotely close to a risk appetite that would be prevalent in a bull market. And then when we go outside of the equity markets and look for other drivers, the Aussie yen hasn't quite broken down yet, but it is starting to roll over. So we want to keep a close watch on this. Copper versus gold topped out a while ago and is now testing former support from underneath, so that's now resistance. And of course, Bitcoin, which we'll have more to say about in a moment, is nowhere near, of course, checking any of the boxes in the checklist of trend change. So all these internal and external relative drivers for the equity market remain negative in our view as well. So this is time for a bit of perhaps a commercial interruption for trend following. It's a little advertisement for trend following. But in the past month, we've heard a lot of comments being made about what some of the smartest investors in the room have done, and obviously the mistakes that they, in hindsight, have made with respect to FTX and perhaps crypto. And as more things unfold and more data comes to light, maybe we'll find other mistakes. But if I'm given the choice between being called the smartest investor in the room or just a simple trend follower, I will hands down choose simple trend follower. And I think the events that are unfolding right now that have tripped up some of the smartest investors in the room is just really emblematic as to why I find tremendous value in trend following, because trend following has had us out of this space for a very long time, at least a year. But if you just walk through this trend in this is a Bitcoin, a cryptocurrency index. I got this from CCI30.com, where they maintain this index. And through the checklist of trend change, you can see how this whole bubble trend peaked out through this process, breaking the uptrend, breaking swing lows, and eventually moving averages, crossing and whatnot. So from a trend following perspective, with this being the key driver, this whole cryptocurrency trend being the key driver behind this ecosystem, we can see that this trend has been broken for a long time, and then how this played out and spilled over into other related assets as the story unfolded is quite a story to be told, and it's something that will certainly make it into the history books and textbooks, I would presume, in the future. But let's take a look at a few of the other asset classes as they responded as the whole cryptocurrency ecosystem fell apart, and despite this, what some of the quote-unquote smartest investors in the room ended up doing anyways. So this is where the cryptocurrency index on the previous slide peaked, and just before all of that asset class peaked out, we had all these other related assets go into trend reversals as well. And of course, the most high profile of these assets would be the ARK ETF, which peaked out actually in the beginning of 2021 with think about again that checklist of trend change. You can see that whole thing unfolding here. And shortly after that, FTX, the exchange, invested $135 million on stadium naming rights, which, believe it or not, is actually a rather classic sign of a bull market top and a bubble top. It happened in spades here. Shortly after that, the coin exchange became public, right into a massive double top. That's this pink line here. And shortly after that, right around the time that the crypto index peaked, Tom and Giselle took a large ownership stake in the FTX exchange. And of course, Tom Brady was on a commercial where he was literally shouting into the video, "You just need FTX." And the whole celebrity endorsement again is just classic. These are things that will make their way into the history books. And of course, Robinhood came public here and basically went into free fall right after that. Now, just almost if you file this under, you can't make this stuff up, but right here, our friends in the ETF business, as they always tend to do, they gave us the meme ETF. If you're not familiar with this was an ETF that was launched that was literally full of all those meme stocks that were so popular in early 2021 and throughout 2020 with the stay-at-home trade and everybody at home day trading. They came out with this ETF right in time for it to peak and then drop roughly 90% or more immediately after it came out. And of course, not to be outdone, Facebook, in sheer exuberance of what was happening in the digital space, renamed themselves from Facebook to Meta Platforms. And once again, not to be outdone, Square very cutely renamed themselves Block. And all of this happened in the span of 1 year. And you can, again, just focus on that checklist of trend change, and you can see it playing out one asset class after another. And despite all of this happening over the course of 1 year, giving you plenty of heads up, trend following investors have been out of this space for a very long period, at least if you've been properly executing trend following. After all of that, FTX in September 21st of this year was in talks to raise up to another $1 billion with giving it a valuation of $32 billion. So, and this again was some of the smartest investors in the room, who presumably have some knowledge of market history and had to be questioning whether or not this was some sort of a bubble. Again, if I'm given the choice between being labeled the smartest investor in the room or a simple trend follower, all I know is that during the good trends, when everybody was long and funding these things with seed rounds, trend following was all over it. But when the trends changed in a meaningful time frame, once again, trend following has been out of this area for a very long time, and despite that, the quote-unquote smartest money in the room doubled down on their bet just before the whole thing was identified as being a fraud, and we'll see what happens to the whole thing, jail sentences and whatnot. But this, from a history book and business case study, this will be one of the ones that's covered, much like Bernie Madoff and Enron and everything else that happened after the bubble in 2000. We have the same thing happening today. It's just to, change the name, change the dates, but it's some of the details, but it's all the same thing. And so, is from a trend following perspective, is it shocking that this is all unfolding and the news is now coming out? Frankly, it's not. This is what the market's been telling us for over a year now. And despite this, and despite all the messaging and everything that history has taught us, the smartest money in the room chose to double down on what just shortly thereafter was identified as being one of the greatest frauds in history. And to quickly summarize our points from the video this month, we're still in a bear market. I think we've presented enough evidence to demonstrate that although there are some things that we'd like, the vast majority of what we're seeing still represents a headwind. And so as a result of that, we still feel that exposures should be grossed down. You should be holding cash if you can. And of course, if you can, you should be deploying short exposure as well in lieu of a fully invested position. While you're in a bear market, take advantage of these overbought and oversold market conditions, and you want to be adding and reducing short exposure accordingly, all the while pushing long exposure towards leadership. So the longs should be focused in trending stocks that are displaying relative strength despite the bear market, not because of the bear market. So as we showed, the utility, in particular the staples space, they tend to demonstrate strong relative performance, but only during bear markets. And so we're seeing staples once again break out from a relative perspective, and there are some positive trends there as well. But by and large, most of what we're seeing there is happening because these are safety sectors and they tend to do well in bear markets. So those don't really interest us from a long exposure perspective. What we're interested in is locating strong trending and outperforming ideas in industrials, materials, energy, as well as some select technology and consumer discretionary names that we've highlighted in recent notes. So we want to constantly be pushing our long exposure to areas like this because the fact that they're outperforming during a bear market is a potential tell that they will be leadership once the next bull market starts. That's a pretty classic development during bear markets, is that future leadership actually tends to be demonstrating leadership quality in the throes of the bear market. So always want to be pushing your long exposure at all times towards these types of stocks and sectors, especially during bear markets when they're leading. So while conditions are still not good, they're certainly better than they've been all year, especially if you compare it to the July to August rally, so that's a positive, and so that gives us some hope that perhaps the end is near at some point in the next few months. But in either case, unless we see a sea change in conditions within technology and media, we're gonna want to remain underweight those two areas, because we do suspect that there's quite a bit of a bubble overhang that could keep them in the penalty box for quite a while. While we're watching this resistance unfold and how the markets address and confront the resistance, whether it be the 200-day moving average or the swing highs or whatever it is that we're looking at, as the markets are wrestling with that resistance, we're going to want to see the support area on the S&P 500 hold up in that 3,800 to 3,900 area. If we start to see that level give way to selling pressure, then the concern, of course, is once again reflecting back on that checklist of trend change. We'd start to see the market starting to check boxes in the wrong direction, which would just give more life to the already ongoing bear market and forestall any hopes for a bear market bottom anytime soon. So that's where we stand for now. We'll keep you posted on any changes that we see throughout the course of the month vis-a-vis our weekly notes. But if you have any questions or you need some follow-up, please feel free to reach out via email, and we'll be happy to help out if we can. Thank you for listening.